Since 1980, median home prices in the United States have skyrocketed by 121%, but typical household incomes only grew 29%. That brutal mismatch isn't a glitch. It's how the system was built. And in 2025, this relentless squeeze on the middle class is set to become absolutely impossible to ignore. If you felt like every step forward leaves you further behind, it's not your fault, and it's not random. Today, I'll reveal exactly why the middle class isn't just being squeezed, it's being mined. I'll show you the hidden architecture behind your rising bills, dwindling savings, and why so many people can't seem to catch a break, no matter how hard they work. Stick with me because once you see the numbers, you'll never look at your finances or America's future the same way again. Let's pull back the curtain on how all of this actually happened. The story starts after World War II, in what's now called the golden age of the American middle class. Imagine a country where wages climbed right alongside productivity. A single income could cover a modest house payment, groceries, family vacations, and even college tuition. Back then, the middle class wasn't just the backbone, it was the engine. Why? Because the economy depended on strong, stable, well-paid workers who could actually afford everything they produced. But around the 1970s, a seismic shift began. The US economy moved from rewarding labor and manufacturing to favoring finance and capital. Productivity soared, but your average paycheck didn't. Companies discovered they could pump up profiles not by selling more, but by keeping wages flat. This was the era when globalization took off. Factories closed up and headed overseas. Manufacturing jobs vanished, and suddenly millions were pushed into the service sector, where paychecks were smaller, benefits were weaker, and workers had a lot less bargaining power. Let's visualize what all that means with a real family. The Turners started strong in the late 1970s. Jim Turner worked as a factory floor tech, earning enough to buy a small home, raise a couple of kids, and even stash away some savings every month. But by the late 1980s, things changed overnight. Jim's job was cut. The plant outsourced overseas. Suddenly, Linda, his wife, had to pick up extra nursing shifts just to keep up with the bills. Together, their income only just managed to cover each month's outflow. In the 1990s, their insurance bills ate up every raise, and then some. Tuition exploded, forcing their kids to take on loans. In the 2000s, they refinanced their mortgage so they could cover college costs. By 2023, their daughter owed $38,000 in student loans, and basic expenses like groceries and utilities consumed every cent they earned. The Turners didn't make poor choices. They navigated the same system millions find themselves trapped in today. Their story isn't about personal failure, it's a perfect example of how the system was engineered to work. Now let's zoom out to the 1980s, the decade where the wiring of the system was completely re-engineered. Taxes for the richest Americans dropped. Unions weakened and sidelined. The financial sector was unleashed with new deregulation. The top 1% started rocketing ahead, while the middle class was stripped of its economic leverage. Where once one paycheck sufficed, now two became essential. When paychecks stopped climbing, credit cards and personal loans filled the gap. Debt piled up, and for the first time, it became absolutely normal for the middle class to be falling behind while wealth raced away at the top. As we rolled into the 1990s and early 2000s, the situation got worse. Housing prices started soaring well beyond any increase in pay. Healthcare costs hit record highs. Higher education became a gateway to massive debt, not opportunity. More and more, the economy reeded capital ownership. Stock buybacks, real estate portfolios, dividend payouts, instead of work. Companies spent billions buying back their stock, but rarely shared those gains by boosting worker pay. I want you to take this in. 45% of American families carry credit card debt from month to month, according to the Federal Reserve's 2023 report. Can you believe that almost half of us are paying banks just to cover the basics? If you relate, you're not alone. It gets worse. Since 1975, median wages in the US have increased by just 19%, but college tuition has exploded by over 200%. Pew Research National Center for Education Statistics. Medical Healthcare costs up by over 500% since 1970. Kaiser Family Foundation. The median home price has soared 121% since 1980. Meanwhile, household income only rose 29%. Federal Reserve. In 2023, the average U.S. mortgage rate spiked to 7%, the highest in 21 years. Freddie Mac. Over 43 million Americans currently owe on student loans, with the average new grad leaving school burdened by $37,000. Federal Reserve 2023. It's a lot to take in. Now here's a question for you. What's the single cost you feel rising fastest in your life? Is it rent, insurance, groceries, or something else? Comment with your biggest financial hurdle right now, because understanding where you're most squeezed is step one to breaking this cycle. Let's get back to the bigger picture. 2008 was the so-called once-in-a-generation financial disaster. Millions lost their homes, their jobs, and their life savings. And while Wall Street bounced back almost instantly, regular Americans never truly recovered. Corporate profits came roaring back. Asset prices soared, but wages barely budged. The middle class wasn't bailed out. It was quietly harvested. Then the 2020s arrived, and all those hidden cracks started to turn into chasms. Inflation surged and outpaced raises. The supply of affordable housing flatlined. Student loan payments, which had been paused for years, came roaring back with a vengeance. Healthcare? Higher than ever. Groceries doubled in price for many staples. Insurance? Sky high. While corporations logged some of their biggest profits in decades, regular workers dealt with less and less. So to make it crystal clear, every single major expense, housing, education, transportation, healthcare, insurance, has grown much faster than your wages. Not by mistake, but by design. Let's break down exactly how this mechanism works. 1. Essential costs outstrip paychecks. Median U.S. wages are up just 19% since 1975, but college costs jumped over 200%. 2. Debt closes the gap. Nearly half of families are carrying credit card balances. 3. Inflation quietly taxes your savings. Medical care now costs 5 times what it did in 1970. 4. Corporate consolidation kills competition. In 2019, just 4 companies controlled 80% of America's meatpacking market. 5. Housing scarcity means wealth gaps widen. Median home prices up 121% since 1980. Incomes up just 29%. 6. High interest rates lock millions into renting. Last year, mortgage rates hit 7%. 7. Education debt steals decades of financial freedom. Average balance, $37,000. 8. Healthcare eats more and more of your paycheck every single year. If this is hitting home, share your story below or drop a money emoji in the comments if you felt this squeeze lately. Ready for the next layer of truth? The system wasn't built to lift the middle class. It was built to extract as much value out of you as legally possible. Through debt, through fees, through dependency. The more stressed the middle class, the better for those at the top. Predictable bank profits from loans. Sky-high rents that lock you into paying instead of owning. Giant corporations that raise prices in lockstep. Private equity buying up neighborhoods and renting homes back to you. It's no accident. It's architecture. Look at what's coming in 2025. Asset management firms grabbing up affordable homes, renting them out at a scale we've never seen. Tech companies are automating jobs faster than people can retrain. The Federal Reserve, by hiking rates, makes it harder to borrow and easier for investors to earn more with what they already have. Global cash is pouring into American real estate, pushing families out. Everywhere you turn, the middle class is under pressure, by design and by data. But, and here's the critical shift, outliers exist. Some escape the trap. Let me tell you about Marcus, because his story is proof that while the architecture is real, the outcome isn't fixed. Marcus is 38. He spent years working in a grocery store, earning $16.50 an hour. Rent and bills drained every paycheck. In 2015, instead of giving up, Marcus invested $1,200, which he had to borrow to earn a project management certificate. Less than a year later, he landed a remote job making $62,000. Now pause here, because this isn't just luck. And I want to show you exactly what Marcus did, plus a TMP you can use yourself. Let's break it down. If you're looking for skill upgrades with the highest return on investment, here are 3 certifications to consider. Each costs less than $1,500 on average. 1. Google Data Analytics Professional Certificate. Cost, approximately $400. Median reported starting salary, $65,000. 2. Project Management Professional PMP certification. Cost, approximately $720. Median salary, $83,000. 3. CompTIA Security Plus. Cost, approximately $450. Median entry salary, $60,000. These are average US numbers as of 2023. And while outcomes always depend on your background and location, this shows how the right credential can break the wage inflation trap. And here's a challenge for you. If you have $300 a month to invest after paying bills, consider this sample index fund allocation for educational purposes only. Ages 20 to 35, 80% US total market index, 20% global equities. Ages 36 to 50, 65% US total market, 25% global equities, 10% bonds. Ages 51 to 65, 45% US total market, 20% global, 35% bonds. Historical averages, which do not guarantee future results. S&P 500 returned about 10% annually, but that came with big swings. In 2008, the market dropped over 37%. Remember, this is educational only, not financial advice. Past performance doesn't guarantee future results. Consult a licensed financial advisor for your specific situation before making any investment or allocation decisions. Back to Marcus. After paying off his high-interest debts and funneling every extra dollar into low-fee index funds, his net worth broke $85,000 within 5 years. And here's a tracking title you can use right now. List every debt, its interest rate, and minimum payment. Pay the minimum on all but your highest rate debt. Throw every extra dollar at that one. As each debt zeroes out, roll that payment into the next highest rate debt. Track your progress every month. Don't skip it. If you want a free template for asset allocation and debt payoff tracking, just comment template below and I'll send it your way or put a link in the description. Now, let's get tactical for everyone. 1. Build income that outruns inflation. Instead of waiting for the annual 3% raise, level up skills or add a side gig. Think about certifications from reputable platforms, not just university degrees. 2. Stop chasing lifestyle upgrades. Every time you upgrade your car, your phone, or your apartment because everyone else is, you're feeding the machine. 3. Redirect any spare dollar into inflation-beating assets. Index funds, retirement accounts, think 401ks, IRAs, or even fractional real estate. Remember, this is educational only, not financial advice. Past performance doesn't guarantee future results. Consult a licensed financial advisor before investing. 4. Minimize high-interest debt, especially credit cards. Interest is the system's favorite wealth transfer. 5. Negotiate everything you can. Rent, insurance, phone bills, medical invoices. Most people never ask. You can. 6. Build multiple streams of income. Don't rely on a single job. Freelance, consult, sell digital products, or take on short-term gigs. Survival isn't about a side hustle. It's about building a buffer. 7. Level up your tax know-how. A side hustle means new tax strategies. A 401k or IRA means smarter deferrals. Using tax-advantaged accounts can save thousands per year. 8. Protect your time. Exhaustion is a feature, not a bug in the system. Clarity and better financial decisions require mental energy. 9. Prioritize building buffers. Emergency funds, stacked skills, automatic savings. Remember, the system assumes you'll skip this step. Prove it wrong. 10. Reject the myth of failure. You're operating in a system designed to keep you scrambling. You're not failing. You're adapting. If you want a copy of my free asset allocation and debt tracker table, ready to fill in for any income level, comment template below or check the link in the top comment. Let's recap the breakthrough. The middle class isn't falling behind due to bad luck or laziness. It's because essential costs have exploded far beyond wages. Median wage up 19% in 50 years. Median home up 121%. College is triple what it was. But by shifting the game, like Marcus, you can create leverage even when the deck is stacked. But here's the real cliffhanger. The next generation is facing a crossroads. Will 2025 be the year the system fractures? New policies, new technologies, or something more profound than anything before? What moves do you need to make to adapt when the rules change again? If you're still watching, screenshot this summary and use it as your next financial checklist. And subscribe, because I'll be revealing detailed step-by-step guides for tax optimization, index investing, and new side income strategies in the coming weeks. The more you see the design, the easier it is to build your way out of it. Let's quickly recap what you've learned. The middle class isn't losing ground because of bad luck or personal mistakes. It's losing ground because every major expense is rising much faster than incomes. You've seen the numbers. 121% rise in home prices versus a 29% rise in income since 1980, a 19% wage bump since 1975, while college costs soared over 200%. But your path forward is through specific, calculated moves. Boosting your income, redirecting extra dollars into assets that grow, crushing debt, and stacking skills that actually break the inflation cycle. Outliers like Marcus prove there's real hope, but you need a plan, and you need it now. Here's what you should do next. Step 1. Today, pick just one cost to tackle. Is it your phone bill? Insurance? Find a way to negotiate, reduce, or replace it this week. Step 2. By this month's end, download or request the asset allocation and debt tracking template I mentioned. Fill out every debt and savings account, no matter how small. Step 3. Over the next 3 months, focus on a single high ROI skill, certification, or side hustle. Direct the first $300 of new earnings into a low-fee retirement account or index fund. Track your progress. Step 4. In 6 to 12 months, revisit your budget and buffer. Did you weather an emergency? If not, build that fund to at least 1 month of expenses. For tools, check the top comment or description for links, templates, and a simple index fund model to get started. If you follow even just these first 3 steps, you'll likely see more breathing room before your very next payday. In 3 to 6 months, you'll see measurable progress, less debt, more savings, and momentum you can actually feel. In a year, you could be in a completely different place financially, even in a system that's rigged to keep you running. But this isn't a solo game. The real move is to take action with our Homer Invests community. If you got value today, early CTA. Drop a comment about your biggest financial struggle, or say template if you want my tracker. I read every one and send free resources back. Mid-video CTA. Don't just keep this to yourself. Share it with one person who needs real numbers, not TikTok hype. Final CTA. Hit subscribe and turn on notifications. My next deep dives will explore how Gen Z and millennials are adapting, and if new policies could finally tip the balance for the middle class. This channel, Homer Invests, shares these frameworks for educational purposes only. Nothing here is personalized investment advice. All examples are for illustration. Before making any decisions, consult a licensed financial advisor or planner. Systemic barriers are real. Past performance does not guarantee future results. Stay sharp, stay persistent, and let's win together.